from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, the Fed unleashes its most aggressive policy in decades to combat soaring inflation. We'll talk with Liz Young of SoFi about what it means for the economy, consumers, and tech. Plus, substantial demand for travel. That is the message from Airbnb CEO Brian Chesky after a much better than expected earnings report. He'll join me live to talk about how tourism is rebounding and that provocative tweet about big changes to Airbnb coming. And 1/3 of Lyft's market cap wipe out in a single session. Uber releasing its results early to prevent investors dragging them down too. Still, Uber shares taking a smaller leg down even after beating estimates. We're going to speak with Lyft President John Zimmer about the market reaction and what's next. All of that in a moment, but first I want to get a look at the markets and a big day for the U.S. economy. The Federal Reserve has voted unanimously to raise the benchmark interest rate by 0.5 percentage point. Stocks soaring, bonds rising during Fed Chair Jay Powell's press conference. Bloomberg's Ed Ludlow is here with the reaction. Ed, take it away.
Yeah, the S&P 500, the main gauge of U.S. equities, rising by 3%, its biggest jump since May, really accelerating those gains throughout that press conference as we discussed. The Nasdaq 100 also up by more than 3%. We saw yields pull back, especially the benchmark 10-year Treasury yield, off by about 4 basis points to 2.94%. And it was interesting to see Bitcoin also get caught up in this kind of risk-on sentiment we saw in markets, back above 39,000, pushing towards $40,000 per token. Caught up as equities were rising. Now, coming into my Bloomberg terminal, producer Marguerite points out to me that this is the biggest jump in interest rates since 2000. But here's the thing, the focus is very much on inflation. The increase in the FOMC's target federal funds rate takes us to a range of 0.75 to 1%. You remember we got that 0.25 percentage point hike in March. But for much of the last 2 years, rates have been near zero because the Fed was trying to prop up the U.S. economy, cushion the U.S. economy from the immediate impacts of the COVID-19 pandemic globally. But the gap between rates and where we see inflation, which is at its highest level since the 80s, is the most on record. The spread between those two measures that we track in the U.S. economy. And Fed Powell was saying that he envisages 50 basis point hikes at the next couple of meetings. He got asked, well, could we see a 75 basis point hike? He said that that was not currently being considered by the FOMC. Not the only story of the day, of course. Lyft and Uber. Two very different stories, but similar market reaction. Lyft off by 30%, biggest drop on record, a huge chunk of its market cap lost after it gave a pretty weak outlook, and there are concerns that it's going to have to spend heavy on driver incentives, which is going to weigh on profit. Uber actually showed some strength. Interesting EBITDA forecast, but again, the stock suffering in conjunction with its industry peer, Lyft. Big questions now about how these two companies in ride-sharing stand on their own 2 feet in this post-pandemic world, Em.
All right, Ed, thank you. Lots to digest today. The Federal Reserve, as Ed's saying, giving a much-needed boost to tech stocks by ruling out a more aggressive rate hike path and reassuring the U.S. economy will stay strong. As he mentioned, Nasdaq 100 up nearly 3%, biggest one-day jump in a week. Liz Young, head of investment strategy at SoFi, joins us now. So look, lots going on here. What do you think the ripple effects of this are really going to be on the macro environment over the next few months and the next couple of years?
Well, the reality of it is that this is the first of probably a few larger hikes that we're going to see. It was important to get this first big 50 basis point hike behind us because I think the anticipation was really killing us as far as investor sentiment goes. But we're probably still going to see another 50 in June. We may see again another 50 in July. The ripple effects of those together should hopefully dampen demand to a point that some of this supply-demand stuff becomes more in balance, and we see concurrently a rollover in inflation. The issue here, and I heard you guys just talking about the spread between the 10-year Treasury and CPI, and the spread between CPI and where the Fed funds rate is. It's not that we're trying to get the Fed funds rate and the CPI rate to meet anytime soon. It's that as the Fed funds rate moves up, We want CPI to move down, and we want to see that move down, hopefully with a quick pace, because that's what's biting into the consumer. But the issue that we're probably going to face through summer is that we're sitting at an 8.5% CPI number. Even if this is the peak, it's not as if it's going to fall from 8.5% down to 3% overnight. So there's going to be a gradual reduction. We're just hopeful that as we raise rates, hopefully for 50 basis points, and we go at it with a heavy enough hammer, that CPI comes back a little faster than the Fed funds rate has to go up.
So look, tech equities are among many stocks that have taken a giant hit this year. What does this mean for tech stocks in particular?
So tech stocks, if we just use the Nasdaq to represent tech stocks, the Nasdaq is in bear market territory. Maybe after today, it's narrowly out of bear market territory, but it probably should have been. And given where valuations were before we started to really worry about Fed rate hikes and monetary policy tightening, some of that needed to come out of the system. Some of that bloat needed to come out of the system. So the correction that tech stocks have seen to this point, I think makes sense given the inflated valuations that we're at. Also, when you look, though, at some of those tech stocks, they're still at pretty high valuations. So I wouldn't sit here and say that they're not going to go down further and that there isn't more risk in the system. But long term, if we look back on this time period, let's say 5 years from now, we're probably going to look at it and say, you know what, some of those names were really good bargains at those levels. So this is an okay time to be looking at tech as a longer term holding. And longer term here, I'm talking about 2 years, 3 years, 5 years. Looking at it as a long-term holding and looking for the companies that are high quality, that are still offering you growth prospects, and that aren't over-levered or aren't trading at unreasonable valuations given where we are in the cycle. So I think it's okay to start towing back in.
Okay, how do you look at a company like Lyft, though, losing 30% of its value? Uber's earnings were a different story, but we're also seeing them take a slight leg down today. Investors are looking at, both of these companies as a gauge of the health of the consumer.
Right. Well, and I think there's a lot of different ways to look at the gauge of the health of the consumer. I think what we're seeing is that because, as I mentioned, a lot of that bloat came out of the system, now you're seeing companies actually react in the stock market based on fundamentals. So we've gotten, not as much of a tailwind from low rates, and you see earnings come out and companies are reacting to that. Generally speaking, the market overreacts in the short term. I also happen to think that this big rally we saw after the Fed meeting today was a slight overreaction, and we probably end up giving some of that back. So it's possible that we just need the dust to settle on some of these companies that have drawn down quite a bit more after earnings reports. But frankly, I want to see the market react to earnings. I want to see the market actually paying attention to fundamentals and wanting to get what it pays for and holding companies more accountable from a fundamental perspective instead of just relying on the macro backdrop to drive prices.
On the other hand, I'm about to talk to Airbnb CEO Brian Chesky. Airbnb seeing substantial demand through the rest of the year. They say, are you at all concerned that some of the demand companies are seeing is pent-up demand coming out of the pandemic and that we're going to see another reordering as we move into next year?
Well, depending on the sector that we're talking about, I think the travel sector is still seeing some of that pent-up demand that people had been waiting to unleash once they could. The problem that the travel sector is going to face in this inflationary environment is that prices are going up, flights are more expensive, hotels are more expensive, all of the experiences that we were hoping to have are more expensive than they were a year ago. So I think people are going to start to make different decisions on that front. As far as pent-up demand, if we're looking at goods companies, looking at consumers actually buying things in stores or things online, I think a lot of that pent-up demand has already been unleashed. And now we're in a place where we can see steady demand, but I don't know that we're going to see again that huge surge in demand that we saw when things started to open back up for the first time.
All right, Liz Young, SoFi Head of Investment Strategy. Great to have you back here on the show. Thank you. Coming up on Thursday, I'll be speaking with Uber CEO Dara Khosrowshahi. That's 11:30 a.m. Eastern Time, 8:30 Pacific, right here on Bloomberg Television. Tune in for that. Of course, John Zimmer coming up in just a moment. And also Airbnb rising as the home-sharing giant predicts big demand heading into summer. CEO Brian Chesky says the biggest change to the company in a decade also going to be announced next week. I'll ask him what he means by that next. This is Bloomberg. Everyone, it seems, wants to get away. Travel experts expect this summer to be one of the best the industry has seen after 2 years of pandemic lockdowns. If Airbnb's earnings are any indication, it will be a busy summer indeed, with CEO Brian Chesky seeing, quote, higher than historical demand. Joining us now to talk about that more, Airbnb CEO and co-founder Brian Chesky himself. Brian, great to have you back on the show.
Thank you.
As always. I know some of the trends you're seeing surpassed even your internal expectations. What surprised you most about the demand you're seeing?
Well, I think what surprised me maybe the most was that I was expecting last year to be the biggest travel rebound that we had probably ever seen in a century. You had never seen so much pent-up demand. And I think that what surprised me is we're seeing potentially even more pent-up demand this year. And maybe that's not surprising. I think people weren't quite comfortable crossing borders. Then you had the Delta strain. And I think you're going to see this summer a travel season unlike we've ever seen before. And the thing about travel is there are some things when they're taken away from you, you kind of don't want to do them again. I don't think that's travel. I think the longer people can't travel, the more they want to travel, and the more ambitious they get.
So you use the words pent-up demand there, and I'm curious how you think this summer might compare to next summer, for example. Are you expecting the growth rate to slow down after people get this out of their system a little bit?
No, I don't think so. I mean, number one, Asia probably won't recover right away. It's going to take some time. And, that's where the large percent of the world population lives. So I think that next year, you're going to see a huge amount of growth coming from Asia. It's going to be a little slower this year. But we have a lot of pent-up demand for Europe and North America. The thing, Emily, that I would just say is this. There are new use cases that are here to stay. People traveling to rural areas, people staying longer, people staying Airbnb for a month or longer. But then our bread and butter historically has been cross-border and urban, and that is now back at or above 2019 levels. So we're seeing a combination of the old trends coming back plus new trends sustaining. That's going to continue. And then eventually you're going to have other geographies like Asia come. So I'm pretty bullish for the next couple of years.
How strong is the consumer in your opinion? Because obviously with inflation, the cost of flights are going up. The cost of travel more broadly is going up. And I wonder if you think, is there a point where inflation catches up with the consumer and overwhelms that pent-up demand?
I think that it could affect travel more broadly, but I think it's very important for me to distinguish our business. During the pandemic, we recovered faster than any travel company. That's I don't think that's a controversial statement. And why is that? It's because we have nearly every type of space in nearly every community at nearly every price point. So when people feel like they can't fly, they can't afford to fly, they can still get in a car and book an Airbnb nearby. And I do think a lot of people still want to go to the house. Airbnbs are typically still cheaper than a hotel. And so we're pretty resilient no matter how changing travel demand occurs.
Lyft, meantime, is getting pummeled today. Investors not excited about their outlook. Obviously, a different company, but another sort of measure of consumer sentiment. And I wonder how you read that, given that people need this kind of transportation to get from place to place, Airbnb or not.
I think that every company is different. And so I think that the phenomenon of how people are moving within cities is pretty distinct from the phenomenon of people traveling. And yes, people do need transportation within markets. But the thing I would just note is about half our business are for stays outside of cities, right? So we have a lot of vacation rentals, rural areas where ride sharing would not be very prolific.
Well, on that note, you are seeing huge demand for homes, and I wonder how that's translating into demand for urban travel. When do you think tourism in cities will fully rebound?
Well, it's already above 2019 at this very moment with Airbnb. I can't say it's above for everyone. I don't know if hotels are back to 2019 levels, but we are. So I think it's already back. I think this summer it will be back. But Emily, here's the difference. Before the pandemic, really our business was dominated by urban areas. And the way people traveled, they would go to Vegas or Los Angeles or Rome or Paris. Now, their consideration set involves hundreds of thousands of places all over the world. They're open in national parks. They're going to rural areas. They're going to small towns. So there's just a lot wider options now.
The APAC region is still struggling with COVID. What steps are you taking there to use your financial resources widely in that region where there isn't much demand? Do you see things improving there?
They are gradually improving, but money can't fix the problem. People just need to get comfortable traveling and need to start crossing borders again. That is inevitable. People will eventually cross borders and travel in Asia more than they ever have before. But until they're comfortable, that's not something we can fix with money. The best thing we can do is wait for that market to be ready. It will certainly start coming back this year. I think you're going to see a much bigger rebound for Asia probably next year. But again, those questions are kind of beyond me. This is really more a matter of where the recovery is for the pandemic in those countries.
Okay, so let's talk about something that's not beyond you, and that is your work from anywhere policy.
Yes.
You've announced that Airbnb employees can work from anywhere, and I'm curious how you think that will impact recruiting and impact hiring.
Well, I'll give you one stat. So we announced last Thursday, I think it was April 28th, that employees of Airbnb can now live and work anywhere in the world. If you move within the country you work, we're not going to reduce your pay. A lot of companies do location-based pay. We don't do that within the country. You can go to 170 different countries, live for 9 days at a time. Since that announcement, more than 800,000 visits have come to our jobs and careers page, 800,000. So I think that gives you a sense. What it tells me is that flexibility is the future. After compensation, flexibility will be the most important benefit employers can offer. The best people aren't just in Silicon Valley. They're not just in New York. The best people are now everywhere. And any company that limits their talent pool to a commuting radius around their office will be at a disadvantage.
You just announced an anti-party crackdown, tightening up restrictions around Memorial Day and July 4th. Still, despite the moves that Airbnb has been making, we've seen people evade the rules. We saw what happened in Pittsburgh and a shooting at an Airbnb that sadly, killed 2 teenagers. What more steps do you think Airbnb could take in this arena to make sure that people are always safe when they're staying at an Airbnb?
Yeah, well, number one, Emily, you just said it. We want to make sure that people always feel safe when they're in Airbnb. And the name of the game is we can always do more. And we're always trying to do more than we've done before. So what we've done is we background check everyone in the United States, every guest and host. We have a risky reservation system where we put reservations on high alert during certain holidays. So this Memorial Day and this July, we're going to be very much on high alert about parties. We've banned party houses, meaning you can't get an Airbnb for more than 16 people in a house that's deemed a party. And so we're doing a lot of things. We're going to continue to get more and more aggressive. The good news is the incident rate has steadily been going down over time. The bad news is one incident is always one too many. So we have to continue to work really hard.
So you tweeted that you will be announcing the biggest change to Airbnb in a decade next week. We're all on the edge of our seats. What more can you tell us?
Yeah, no, you want me to say it right now, do you? Well, I'll just say this. Number one, I'm really excited because we have the biggest updates to our product in 10 years. We've been thinking about this for a very long period of time. I can't say a lot, but I'll just give a couple clues. Number one, there'll be a whole new way to search on Airbnb. And this new way to search is going to be a new way to find really interesting homes. And then the second thing is we're going to have a big step change to our service level and the kind of customer service we offer. You'll see a number of updates next week. I'm really excited about it. It's May 11th, 9 a.m. Eastern, right on our homepage. There'll be a small video, a short video, and you can get all the updates then.
We will be watching. I got to ask you about crypto payments. I know that was a top suggestion from your users. What progress have you made on that?
We've been steadily making progress insofar that we've certainly researched it. We've looked at a number of ways that crypto could be used. Obviously, it's a popular request for people to pay with crypto or be receiving money with crypto. But that's about all I can say right now.
So look, I know you've also been tweeting about Web3 and, curious about what it does and does not mean. How do you see, Web3 or crypto opening up new possibilities for innovation, or are some of these technologies potentially overhyped?
Well, I think both are very possible, right? I mean, I was not around during the dot-com days. I was in design school at the time, but most of the companies during the dot-com era aren't around. That being said, almost all the ideas from dot-com that didn't work now work in some later incarnation. So I think that the technology is really exciting. I think the idea of empowering people all over the world is really exciting as well. But I also do think that, like any new emerging technology, the vast majority of companies will probably not be around in the future, but the ones that will be around could be really, really large. Look at the dot-com bubble. Amazon emerged from that. It was a huge company. So I do think there will be really large companies emerging, but just like, there's a lot of speculation.
All right. Well, looking forward to next week, Brian. Hoping to speak with you again then, May 11th. Brian Chesky, CEO of Airbnb. As always, thank you for taking the time today. Coming up, why bother? That is the question being asked inside Twitter right now ahead of an impending sale to Elon Musk. More on what the company is doing to motivate staffers next. This is Bloomberg. A few other stories we're continuing to watch. Twitter doing its best to quell concerns of employees ahead of the Elon Musk pending acquisition. At an internal meeting, Twitter's VP of product tried to appeal to workers' sense of community, saying they have a responsibility to each other. This, according to people familiar with the matter. Twitter, which employs more than 7,500 people, warned about a possible staff exodus in a regulatory filing this week. Musk has suggested cutting costs, including layoffs, as part of his plan to grow Twitter. The Securities and Exchange Commission is investigating Didi's chaotic 2021 debut in New York. That is when the ride-hailing giant raised $4.4 billion days before revelations of China's probe into data security tanked the stock. Before today, Didi had fallen 85% since last summer's IPO. And the White House is boosting support for quantum computing as China pours billions into the next generation technology. President Biden signing a couple of tech-focused directives Wednesday. One would require the country's most vulnerable IT systems to adopt new standards against the threat of code cracking from quantum computers. Coming up, Lyft shares taking a big beating. I'll be speaking to Lyft President John Zimmer, getting his take on the market reaction and what's next. That's coming up. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Let's get back to earnings with Lyft shares tumbling after providing a disappointing second quarter outlook. Even as revenue in the first quarter beat estimates, the ride-sharing company planning to spend more to attract drivers on the road ahead. The stock falling as much as 29%, its steepest ever drop in a single session. I want to bring in Lyft president and co-founder John Zimmer for his take on all of this. So, John, clearly investors are spooked here. What is your response to their response?
Look, it matters to us, the response. We don't like it. We take it seriously. And we believe we're doing the right thing for the long-term shareholder value. First reflecting on Q1, Q1 was a good quarter. It was a new COVID high for rides. We had improvements on both the driver and rider side. And obviously what the market reacted to was us saying in Q2, coming out of Q1, where we had the largest spike in COVID cases with Omicron, we want to make some additional investments in the market where we see a lot of upside opportunity for return on those investments. And I think, what the market wants to hear is more guidance on what they're going to get for that. And so we'll certainly do that in the quarters to come. And it's on us to prove it as we put up numbers in Q2, 3, and 4.
Dan Ives of Wedbush referred to your spending guidance as a 1980s rock star-like disaster. Part of what you're spending on is driver incentives. What about concerns that this could lead to a race to the bottom, a subsidy war with Uber?
Yeah, well, I think that prior statement is extreme and not really tied to what we're doing here. And I'm not concerned about a subsidy battle. There are some fundamental investments we're making. The one that we talked about and that got the most attention is on the driver side. You had a lot of inorganic things happening when you have spike in COVID, whether that's a quick reduction in demand, a quick increase in demand. and the need to add drivers quickly. We are seeing drivers come back organically. In fact, year over year, we had 70% new driver activations. But based on data we're seeing now, there's a lot more demand on the horizon, and we want to prepare for that in the most responsible way to have low ETAs. And investing in drivers and investing in our marketplace technology, to us, is a prudent way of doing that.
You've said the cost of incentives will be passed down in part to customers. Do you have any concerns about alienating riders?
We always think about the price. I mean, that's actually a big part of this investment, is to make sure we have the best ETAs and the best prices in the marketplace. And so I think we're tying a few separate things. When you have dynamic pricing and prices go up, those go down and are paid for by the rider. But we're making a few investments here, that being only one of them.
So investors are also wondering if they've overestimated the opportunity in ride sharing. Are higher prices here to stay? Is ride sharing a utility for the masses or a luxury good? And how much growth is there really to be had in the rider base?
Yeah, I mean, we're reporting on Q1. Again, Q1, we had 40% growth year over year. You had 4.3 million more active riders than in a year ago. And so we're seeing that growth. I think what's not being given credit anymore is the fact that we're coming out of a pandemic, and we need to, in our business, demand turns on a dime and supply takes a few additional months or quarters to catch up, and we want to get ahead of that.
But do you see ride sharing as a utility for the masses, or with higher prices? Is this something that a smaller group of people, only a smaller group of people, can afford?
No, a growing number of people, as I just said, with the 4 million new active riders are going to be turning into it. We just had 2 years where people were asked to wear masks and not be around each other. We're coming out of that. We have continually seen historically, and then now coming out of the pandemic, more and more people turn to this use case. We're going to be bringing back shared rides, which has been missing for the pandemic, which is a lower price product. We bring in other lower price products with Wait and Save. So I'm not concerned. And in fact, the message we're saying is that we see the demand coming back, and therefore we want to invest in supply.
Now, Uber says they're not going to be spending significantly to maintain or increase supply. You know, they're talking about tweaking their algorithms to make things more transparent for drivers, for example. Is this something that Lyft would consider, other incentives to pull those levers to get drivers to come over?
Yeah, this is not pure incentive. So we're investing across the board in the experience for drivers. And so a lot of that is in our marketplace technology, whether that's maps that improve the experience and allow drivers to earn more and have higher utilization, whether that's our pricing algorithm to fine tune specific things that happen at, say, an airport when multiple planes unload at the same time. And all those improvements pay off as rides continue to rebound. And we feel strongly that these are the right investments to drive the most growth in both the short and long term.
How much overlap do you see in drivers versus, you know, there's Uber drivers that you're competing with for people and for food, but are you also competing with Instacart and Grubhub and DoorDash and Amazon and, you know, Domino's Pizza? They need drivers too.
Sure. Within the category of drivers, there is the highest earnings historically, on average, have been found within the rideshare segment. Also, we typically require newer vehicles, and background checks and driving record checks are always required on our platform. That is not something in these other industries that you named that is always the case. And so there are segments of the population that want to earn more and that have access to newer vehicles and are willing to go those background checks.
Now, I want to move to another story, huge story that we're watching. I know you're watching, the leaked draft opinion from the Supreme Court that signals that Roe versus Wade could be overturned, and soon. Lyft has already come out in support of women's reproductive rights. You've said you're going to defend drivers facing legal action in states like Texas and Oklahoma, where we've seen anti-abortion laws make progress. What's your reaction to this draft opinion, and what more is Lyft prepared to do?
Yeah, it's very concerning. As you said, we've been very clear on our viewpoint on women's right to choose their and have their reproductive health access. And we've made a donation to Planned Parenthood, a significant donation to support their work on that. We were the first to speak out on the laws in Texas and then more recently in Oklahoma. Speaking out is important, as are the actions we take. And so we're working to make sure women who are coming to a different state have access to transportation to make that traumatic experience a bit less stressful. And we'll continue to speak out when we think the rights of our community are at odds with what's happening in the world.
If this issue is turned over to the states, potentially half of states could enact laws like this, and some of those laws would be triggered immediately. Is Lyft prepared to defend drivers on a national level?
Yeah, I mean, the specific laws that we reacted to in Texas and Oklahoma, in addition to disagreeing with the overall viewpoint and believing that women should have the right to choose, there were laws that said that a driver, without them even knowing where they're taking someone, could be found criminally liable for taking someone to an appointment that they had no idea where they were going. That is wrong on many levels, and that is something we will continue to defend our drivers from.
Do you have any concerns about alienating riders and drivers by taking this stand? I mean, obviously, you are running a business. Why speak out on this?
It's important for companies and individuals to speak out when they disagree with something. We've shown that throughout our history. We're not afraid to speak up. We think ultimately doing the right thing for society and speaking to that can also be beneficial for the business. But we care deeply about our impact and our ability to impact the world around us.
All right. John Zimmer, Lyft president and co-founder, thank you for stopping by. I want to stick with Lyft and Uber now, take a closer look at the stock moves, obviously that big move from Lyft. Ed, talk to us about the size and scope of these moves.
Right.
Obviously, we heard John Zimmer's response there. He said he doesn't like it, but he disagrees.
Yeah, and investors clearly concerned, right? 30% drop in the stock is significant. Biggest drop on record, as you said, Em. The other way of looking at it is, it's more than $3.5 billion of market cap loss in a single session. Come with me into my Bloomberg terminal. Look at this chart. This is the way I've been thinking about this throughout the day. That these two stocks in particular, since their IPOs, both of which took place in 2019, of course, have not performed well, right? You see that as we emerged through the initial phase of the pandemic and things improved, we saw a rebound. But actually, as part of the kind of conversation around economic reopening, mid-2021 through to present day, these stocks have seen declines. And even Uber, down as much as 12%, 1 point on Wednesday, ended up dropping by the most in 5 weeks. There are a lot of questions here about whether these two companies can stand on their own 2 feet. There were two quick charts I wanted to show you. The first, Lyft. There are some bright spots. One of them is revenue per rider. Pretty high, around $49 in revenue per rider right now, way above where we were in 2019. But if they're going to spend on incentives, growing the top line through raising prices, that's not really satisfying for investors, although a lot of Wall Street analysts said this was overdone because by investing in the drivers, and you just heard it from John Zimmer, that is a bullish sign that Lyft sees demand coming in the future. And then finally on Uber, they didn't fare well in the equity markets Wednesday, but lots of people pointing to their different business model, right? Orange part of the chart is mobility, rides, but delivery, increasingly important. They have a diversified business. And you heard Dara Khosrowshahi, and I hope you ask him about this at some point. Well, what are they doing to win over drivers? They're saying, come to our platform. Don't just drive people. You can also do delivery. You have the choice and maximize the money that you can earn. And it's a really interesting differentiation.
All right, Ed Ludlow, thanks. Coming up, the role Nasdaq plays in crypto markets and how that could grow with more regulatory clarity. We'll talk about that coming up next. Time now for our crypto report, and even with falling equities and delayed IPOs, some companies are still looking to make their stock market debuts, according to Nasdaq CEO Adena Friedman. But what insights does the Nasdaq have, and what role will it play in crypto markets? Friedman spoke with Bloomberg's Kaylee Lyons and Guy Johnson earlier today. Take a listen.
Nasdaq today is actually a scaled technology company that serves the broader capital markets and the broader financial system. So we, in fact, have a big role to play in facilitating and helping crypto markets, as well as banks and brokers manage new digital assets. So we provide our technology to 130 other markets around the world, including, actually, I think we're up to potentially 10 crypto markets now that are leveraging our technology for trading, for surveillance, and for other means that they have to make sure that they can grow and expand their business. We also have a very scaled anti-financial crime technology solution where we've created a new module specific to digital markets to make it so that banks can evaluate AML risk as well as fraud risk in their digital wallets as well as in their more traditional accounts. So we have, and we also, one third thing is we have a crypto index that we've launched outside the United States, index products we've launched outside the United States. So we have a role to play there, but as a market operator, I think that we're still trying to understand the regulatory landscape as well as the overall maturing of it for the institutional use of crypto before we make bigger decisions as a market operator.
Nasdaq CEO Adena Friedman there. And it seems California's governor has heard Adena Friedman's calls for more regulation. Governor Gavin Newsom just signed an executive order to spur blockchain innovation, making California the first state in the U.S. to start creating a regulatory framework for Web3 companies. He said in a statement, too often government lags behind technological advancements. So we're getting ahead of the curve on this, laying the foundation to allow for consumers and business to thrive. Coming up, how the Fed rate hike could impact tech valuations and investing. More on that next. This is Bloomberg. I want to get back now to the biggest story of the day, and that is the Fed's rate hike, the biggest since 2000, and the Fed signaling more to come, all to tamper inflation. I'm joined now by Mark Goldberg, a partner at Index Ventures, to give us some thoughts from the VC world, and he's also got some insights on fintech. Mark Goldberg of Index, thank you so much for joining us.
Thank you for having me, Emily. It's a pleasure to be here.
So look, big macroeconomic changes afoot. What is your advice to founders right now in this moment?
My advice is to build. I mean, we're coming off a year that was the most exciting, exuberant year in not just fintech, but in the tech venture capital market in a decade, and where money was available in spades. And now we're at a time where the market has changed, and what we're telling our companies is to focus on building, not fundraising.
So how do you build without funding?
Well, the nice thing is because so many of these great companies raised huge balance sheets last year, they have the luxury of not having to go back to market, and so the distraction of constantly funding every 6 months, 12 months has gone away.
How is this impacting VC sentiment? I mean, I know that private market valuations are going down. Can we expect that to continue?
The way it's impacting sentiment is the sentiment is about as negative as you've seen. If you saw Bill Gurley's tweet and just the broader sentiment in South Park today, it's negative. I think that's oversteered. I think what we're seeing is an opportunity. And if you look at Index and other VC funds, the best investments are made at times of, on the other side of a cycle, and that's the opportunity we have in front of us
So
today.
how is that impacting your strategy at Index?
Well, we're focused on what we always focus on, which is can we find the best founders and can we get behind generational companies? I think if that North Star holds true today, through cycles, we're going to be just fine.
You're predicting a tsunami of fintech M&A this year. Where specifically?
I think what we're going to see is a massive wave of consolidation. Again, last year was the party, this year is the hangover. We saw a lot of excitement, and what's going to happen now is that consolidation. The exciting thing, though, is the number of consolidators in the fintech space. If you and I had had this conversation 5 years ago, we would have thought about fintech as a vertical. What it's done is it's become totally horizontal. The acquirers are not just Bank of America, JP Morgan, Goldman Sachs. Now it could be Apple, it could be Google, it could be Stripe. So the number of acquirers has grown significantly. It's going to be a really exciting year.
Will we see crypto joining forces with traditional finance? Is that going to be part of the M&A?
I think it might be. I think the crypto yin to the Web2 yang is absolutely a possibility, and I think we'll start to see those combinations in this year.
You've made a number of predictions. Before the start of this year, you said fintech in the metaverse, Gen Z on the rise, Gen Z traders on the rise, Stripe buying OpenSea. They are rolling out some more crypto features. Which of these things do you think is still going to happen?
Well, I think we still have 7 months of the year, so I'm going to wait on evaluating my predictions till then. But I think one of the more exciting trends from last year is this fusion of fintech and culture. And we talked about the meme stocks of last year and Robinhood, and I think what we're starting to see is that fusion of fintech entering the pop culture mainstream, the way that Cash App has a clothing store. Who would have thought that a bank would be, people would be wearing the clothes from a bank? I think that is one of the durable trends that's going to propel us in the next few years.
Robinhood is way down from last year, and the Gen Z traders are on Robinhood. So what's going on there?
I think Robinhood's genius was the ability to democratize access to the stock market. And if you step back from Robinhood, that has been one of our biggest themes at Index, which is how do you think about serving the 80 million underserved Americans? Actually, one of my most recent investments is called Nova Credit. They actually are able to offer immigrants without credit score an ability to get a mortgage or a car loan. And we think expanding access is really one of the big themes we're going to be working on this year.
Now, you are investors in a company, or were investors in a company called Fast, this one-click checkout area, which just recently disappeared completely, just went under, said they ran out of money. What happened there?
Well, our investment in Fast was around this concept, like you said, of one click out. And what I think you saw with anyone who's been through an Amazon checkout experience or a Shopify is there was an opportunity for streamlined checkout. That was our thesis behind Fast. Obviously, it didn't work out. That's venture capital. But we're still really excited about the thesis and getting behind great founders.
Now, let's talk a little bit about SPACs. Some are saying that SPACs are a four-letter word. And, there are many good four-letter words, but there are a few not good four-letter words. What do you think about that?
I think SPACs was an interesting innovation, but as with the broader market, we're going to see what's durable and what was more of a, maybe something that didn't last as long.
So where are you placing your bets?
Within fintech?
Yeah. And beyond.
For me, right now, what we're focused on is finding opportunities in the fintech space, consumer finance. I think there's this tremendous generational shift between people that want to do banking from their phone, a lot driven by the pandemic, versus doing it at a branch. So today, less than 10% of consumers use a digitally native bank. That's going to change in the future. The second area is going to be payments. So I think those are the opportunities we're most excited about today.
Now, you were an investment banker during the Tesla IPO. What was it like to work with Elon Musk back then? What do you think of him taking over Twitter?
Back then, it was quite the formative experience for a 23-year-old straight out of college to get thrown into that. He was the same iconoclastic figure he was then as he is now. I think he had a few fewer zeros on his balance sheet at that point, but the same attitude.
Do you like the idea of him owning Twitter? We're looking at some of your tweets right now, so you're on there.
What I'm excited about is Twitter as a private company, what they can do if they optimize for the long run as opposed to quarterly earnings. So we'll see. There's so much uncertainty in the direction that he'll take the company, but I like the idea of it being private and seeing what they can build from there.
Do you think they should open source the algorithm? Is that going to change things?
I can't speak to that, but I think it is going to be exciting what they can focus on if they don't have the same short-term horizon.
What about employees who want to leave? A lot of people there right now, they don't know if we literally have a story called Why Bother? That's what employees are thinking.
We're going to have to see, there's obviously been a lot of negative sentiment, but, if they can make the right long-term bets, it's going to be an exciting platform for years to come.
All right, Mark Goldberg, Index Ventures, thanks so much for joining us.
Thank you.
Coming into the studio.
My
Appreciate
pleasure.
it.
Thank you.
That does it for this edition of Bloomberg Technology. We'll be back tomorrow. I'm talking to Uber CEO Dara Khosrowshahi. He'll be joining us live, 11:30 a.m. Eastern Time. Tune in for that. You don't want to miss it. We've also got an action-packed show, Lisa Su of AMD, and much more coming up tomorrow. This is Bloomberg.